this video, I'll just be explaining and going through the data of accounting financial indicator formula sheet, just to show you guys how to maximize your marks whenever you are required to complete any questions that are based on your formulas. So the very first one is gross profit over sales. What this one shows is your markup, but the markup on the sales. So that means your sales 100%, your cost is a certain percentage, and then that depends also on your gross. Let's say your gross is 30%, and then that simply means your cost is 70%. All right. So now your gross profit on cost of sales. So that's also your markup, but it's a different type of markup. It's a markup on cost. That's where your cost is 100%, and then your sales are 100% plus gross. So at sometimes you can refer to gross as your markup. It's one and the same thing, just different terms. Okay, so that's just about it. And then the third one, net profit before tax over sales. So this one shows how much of the sales is your net profit. So what portion of sales is your net profit before tax? Okay, it's just simple as that. And then the net profit after tax is similar to the net profit before tax. So it is just asking what profit of your sales, what portion of your sales is your net profit after tax. Operating expenses business is able to control its expenses because 1, 2, 3, 4 are so similar that you can easily understand. And this one asks what portion of sales is expenses. It's as similar as that. You can't go as far as that. Okay, and then our operating profit, out of the total sales that you made, how much of that is operating profit? See, if you interpret the formulas as such, you will never go wrong, because that's what the formula is asking. All right, so these are quite easy. These are just the first ones that you can just easily memorize. You don't even need to memorize because the formula sheet is given. You just need to know what they require from you. Okay, so now total assets to total liability. So this is what we call the solvency ratio. So this one tests the ability of a business to pay its long-term and short-term liabilities as in comparison to all the assets of the business, which are your current and non-current assets. So that's your solvency ratio. And then now what we do have next is our current ratio. So this is the current ratio. It compares, remember that it compares your current assets to your current liabilities, whether you're going to be able to pay off your short-term debts using your current assets that you have. And it's not also complicated, but what these two test, this one is testing for liquidity, this one is testing for solvency, as I've said that it's a solvency ratio. All right, now current assets minus inventories as to liabilities. So this one is what we asset test ratio. Now the asset test ratio says that whenever you are do any operation, or the customers just decide to ditch the business and now they don't want to buy our stock, would we be able to pay off our current liabilities without any sale of stock? So that's what this asset ratio is testing. Okay, now we move on to the next one, which is non-current liabilities as to shareholders' equity. This is what we call the debt as to equity ratio. Please excuse my handwriting, that's just a little bit small, so I'm trying to squeeze the words into the boxes, but I hope as I'm speaking you are following on what I'm saying. So now back to non-current liabilities as to shareholders' equity. So this is to show how much of equity is compared to non-current liabilities. So what this says is that, does the business depend on non-current liabilities to finance the company or the business or whatever? So it tests the degree of financial risk and how the business is financed. If it is high, then that's where you know that the business is high risk, and they have, I wouldn't say much more loans, but they use more loans to finance the business. So it just compares what the business has as equity and the non-current liabilities. Okay, so that is your debt equity ratio. Then now you have trade and other receivables plus cash and cash equivalents or current liabilities. So this is the same as your asset test ratio. You have an option to choose on which one to use. Okay, so I won't be explaining that once again. But if you feel like you didn't understand what I said, you can just keep on rewinding the video and replaying it once again. Okay, so average trading stock over cost of sales. All right, so now we are dealing with this one. All right, it's average trading stock over cost of sales. If you're not understanding the formula, just take some time and think about it, but not too much time, because of course in an exam you can't be going there not understanding any of the formulas. But unless you're watching this video, then you definitely go to the exam and you'll be knowing, not even, let's say not all, but you should be able to understand at least 90% of the formulas, because you can't really memorize all of them. But using the formula sheet and understanding all of them is really important, of course. So now back to average trading stock over cost of sales. What does this say? So this is talking about trading stock. First things first. Now you can see that, okay, this is talking about the control over stock. Okay, it's just showing how you are able to control your stock. How do you trade your stock? And then we are moving on to cost of sales over average trading stock. So now we're looking at cost of sales. Okay, let me just highlight cost of sales over average trading stock. So what this one does, it checks your stock turnover rate. How much or how many times, should I say, do you buy stock per year? So this is your stock turnover rate. And then at that instant, I just forgot to say that this is your stock holding period. Okay, so this is your stock holding period. All right, so be careful of that. So this is your stock holding period, and then this is your stock holding your stock turnover rate. And then we move on to another one. So it is average debtors over credit sales multiplied by 365 times 1. So you'll see these ones that are multiplied by times 365, they represent the number of days. Okay, it just shows the number of days your stock is on hand on average for this one. Okay, so now average debtors over credit sales. This is control over debtors, because I'm writing all of these controls so that whenever you are required to comment on these financial indicators, then you will be simply able to explain that if it's high, you're supposed to say such. If it's low, you're supposed to say such. Now, it's just control over debtors and show how you're able to collect money from your debtors, how much you're giving to debtors. It's just average debtors over cost over credit sales, and it's average debtors collection period. Like how much can you collect? How fast are you collecting from your debtors? I really can't give more explanation to that. Okay, so now it's the next one, which is in contrary of your average debtors. It's your average creditors over cost of sales, or your credit purchases. So here they said cost of sales because your purchases could be in your cost of sales, all of them could be in credit. Like you could purchase your stock in credit, on credit. Now this is to show your control over creditors, how long you take to pay your creditors. Okay, so you can really interpret financial indicators any way you want to, but this is really how I used to interpret them when I was in matric, and that's how I got to understand all of the formulas. And now, moving on, we have net income after tax over shareholders' equity. I guess this is what we'd call the ratio. I used to love this ratio because it shows the return on shareholders' equity, what the shareholders get as part of the profit, and it's a really important indicator when it comes to the context of companies. All right, so this one is not really a complicated one. To net income after tax over average shareholders' equity. Whenever they said average, you know that you have to multiply by half, and then you add the two balances, one from last year and then one from this year. Okay, so that's not really a complicated one. The net income after tax over the number of shares issued. Like I said, just take some time, and if you feel like you're confused, okay, net income after tax, what's that? Now you know net income after tax, it's net profit after tax. Same thing. Over the number of shares issued. So here they are distributing the number, the net profit after tax over the number of shares issued. So if you could just take a look at that, what does that mean? It just simply means the earnings per share, because these are your earnings, and then these are your shares. So if you could just simply interpret your formulas like that, yeah, I'm telling you, you are definitely going to ace accounting. I could not give more I can't give more explanation other than this. Also in this one, because it's just simple as net income after tax, and we're distributing the net profit on each and every share. That is why it's called earnings per share. So how much each share is getting from your net profit, right? Now, this is quite a long one, okay? So you really need to open your ears for this one. This is what we call your ROTCE, or your ROTCE, or whatever you want to call it. So your return on total capital employed is entailed by the formula net income before tax plus interest on loans divided by average shareholders' equity plus non-current liabilities. Okay, I'm saying this slowly so that you can get the gist of what I'm saying and get to understand the formula as I explain. Okay, so the net income, the ROTCE, it explains as of the funding or the financing that the business has had, and all of the costs that the business has incurred through the financing. Okay, so this is cost of financing, which is your interest on loan. I'll just explain bit by bit. So net income before tax, we don't want tax because tax just reduces what we have earned. It reduces our return, so that's why we reduce tax. And then we use our net income before tax. So these are the earnings before tax. And then we have average shareholders equity. That's what your shareholders have in average. And then now you have your average non-current liabilities, which are your loans. Okay, so here we are trying to see on the borrowings that the business has had, the financing. So what's below here, if you could remember on your on your cash flow statement, these two, your average shareholders equity and your non-current liabilities, they go under financing activities. That's where we issue shares and we make loans, right? Financing activities. So here we want to actually check, of these two financing activities, how much have we made? Okay, how much have we made? What's the percentage that we have made from the two financing activities? Like, did we make a profit? Did we utilize them? Like, I'm making a loan, and in obtaining this loan, my aim is to make profit. So how would I measure my return? I would measure my return by using the return on total capital employed. So this is your capital employed. My total capital employed is what's underneath here, underneath the formula. So my return is on top. Okay, my return, that's what I've returned. Return on total capital employed. So if you forget, then you know that your R is at the start. That's your return here on total capital employed. Capital employed, you know, CE, it's just below here. All right, so that's a lot of admin, but I just hope it sinks in. If you didn't understand, feel free to pause the video and rewind. All right, so now I'm just gonna erase this so that I can have some space for our shareholders equity over the number of shares issued. Once again, shareholders equity over the number of shares issued. This just shows your net asset value. I could say per share, but when they ask in questions, they're just gonna ask for the net asset value. So this what it shows. Remember that your net asset is your equity. It's nothing different from that. So I'm just gonna show you something real quickly. If I say assets are equal to liabilities plus equity. So that simply means equity is equal to assets minus liabilities. And you could see that if you subtract all your liabilities from your asset, what do you get? Your net assets. So that is why we say your net asset value is the same as your equity. That is why here they say shareholders equity over the number of shares issued. So you want to see what's your equity per share. Like if the company were to be, if the company was to be, let's say, liquidated, each shareholder would be getting a certain value of the net asset value. That is why it's called the net asset value per share, like how much each share is worth. That's another approach to it. Okay, and then our dividends for the year over the number of shares issued. I think this one is really easy also. It just states your dividends per share. So this one is quite straightforward, DPS. So dividends, you know, these are dividends, then this is pay, this is share. Okay, interim dividends over number of issued shares. That's also straightforward. I don't really need to go a mile and back on this one. Let's just you know, it's interim dividends. I just say I dividends over shares in issue. Shares in issue. Be careful here. These are not quite, but they're actually similar. These three actually, let me just draw a triangle here. These are similar, so you need to be careful of those. If you're required to calculate final dividends over a number of shares issued, that's when you calculate your dividends per share only using your final dividends. Here you use your interim dividends, and here you use your final plus your interim on this one, because they said dividends for the year. And remember that dividends for the year comprise of final dividends and interim dividends. Okay, so that's quite messy. All right, and then next one is dividends per share over the earnings per share. Remember earlier, just a moment ago, I explained the earnings per share. So on how much we earn per share, how much have we given out to our shareholders? Remember that this is what we give out to shareholders, right? That's how much we are paying to the shareholders. And how much of what we've earned, remember that this is what we've earned. How much of what we've earned have we actually given out to the shareholders? How much of what we've earned have we given out? Cool. Now, dividends for the year over net income after tax. Okay, so also this one, from the net profit, how much did we give out as dividends? I think that might be clear, but I can't really explain much further than that, because it's just basic accounting, like just understanding the formulas. I know at some point it might be, you might find it overwhelming at the start, but try to understand what the formula is asking from you. It's just dividends for the year over net income after tax. Remember that every time we're calculating percentages, it is supposed to be what portion. Like every time, just note, every time you are asked to calculate a percentage, you're supposed to know that, okay, I need to know what portion. Like here, for instance, it says dividends per share. What portion of the earnings per share was dividends? You understand? What portion of the earnings per share was dividends? Right? Now, it's dividends for the year over net income after tax. Dividends for the year is what we've given out. How much have we given out over the net income after tax? All right. So these two are also quite similar, because this one is looking at your net profit after tax. But here, remember that on your earnings per share, we have divided your net income after tax by the number of shares issued. Remember that. Okay. So this one will use the full profit, and then this one will simply just use the earnings per share. All right. Now total fixed costs over the selling price per unit minus variable costs per unit. This one is your break-even point. Right. So your break-even point is also quite simple, as long as you remember the formula. The break-even point, that's where you make no profit, no loss. I think we've come to the end of the video. Okay, the note, it says, in this case, if there is a change in the number of issued shares during a financial year, the weighted average number of shares is used in practice. Oh, okay, this is quite important. So for your earnings per share, they're talking about this, because the number of shares issued in the year will change. Let's say maybe we're issuing shares in in the middle of the year. So that's where you have to consider the number of shares in the weighted average form. So that's where you need to add your shares that were added, and then you find the weighted average. Okay, so now we have come to the end of our video. I hope that was really helpful. Thank you so much for joining me today as we were dealing with financial indicators, the formulas per se. Don't forget to like, subscribe, drop a comment on whatever help you need with on content related to accounting. Thank you so much once again. I'll definitely see you in the next video. Cheers.